In 1972, some of the smartest investors on the planet looked at the stock market and said the same four words that have destroyed more wealth than any recession, any crash, any financial crisis in modern history. This time, it's different. They were wrong. And the people saying it today, they're going to be wrong too. Because right now, the US stock market is flashing the exact same warning signs it did in 1972, right before one of the worst crashes in American history. A crash that wiped out 50% of the market. A crash where the world's biggest companies lost 60, 70, even 90% of their value. A crash the market took 8 full years to recover from. And almost nobody is talking about it. So today, we're going to talk about it. To understand the crash of 1973, you have to go back to the late 1960s. America had just won World War II. Factories were running 24 hours a day. The middle class was growing, suburbs were popping up everywhere. And most importantly, people had blind, unshakable confidence. From 1945 to 1970, the US stock market gained over 350%. 350% in 25 years. And when markets go up for that long, something dangerous happens. People stop asking, is this priced correctly? And start asking only one question. How much more can I buy? This is when a new investing philosophy started spreading like wildfire. It was called investing in one-decision stocks. The idea was simple. Certain companies were so powerful, so dominant, so deeply embedded in American life, that you only had to make one decision about them. Buy. That's it. Just buy. Never sell. Never think. Never question. These stocks became known as the Nifty 50. Companies like Coca-Cola, McDonald's, American Express, Xerox, Polaroid. Household names, bulletproof businesses, America's finest companies. Sound familiar? Here's the thing about bubbles. They never feel like bubbles when you're inside them. They feel like opportunity. They feel like genius. They feel like, you guessed it, this time it's different. But the numbers told a very different story. The average PE ratio for the overall market in 1972, about 15. Normal, reasonable, the kind of number that makes sense. But the Nifty 50? Coca-Cola was trading at 46 times earnings. Xerox, 49 times earnings. McDonald's, 86 times earnings. Polaroid, 90 times earnings. On average, the entire Nifty 50 group was trading at 42 times earnings. Nearly 3 times the market average. And it gets worse. The top 5 Nifty 50 stocks alone made up 25% of the entire US stock market. The full group of 50? They were 45% of everything. Nearly half of every dollar invested in America was sitting in just 50 stocks. But they're bulletproof, right? Right? In 1973, the dominoes started falling. Not one domino, all of them, at once. Oil prices quadrupled almost overnight. Inflation exploded from 3% to over 11%. Unemployment doubled, from 4.5% to 9%. And President Nixon ended the gold standard for good. The stock market didn't care how bulletproof these companies were. It came in and did what markets always do eventually. It repriced reality. The S&P 500 dropped 50%. The worst crash since the Great Depression. Coca-Cola, the most bulletproof company in America, fell over 60%. McDonald's fell over 70%. Polaroid collapsed more than 90%. The so-called one-decision stocks turned into one big financial obituary. And here's the part that really hurts. This wasn't a cute little V-shaped recovery like we saw after COVID. It took 8 years. Until 1981, and for the market to get back to where it started. 8 years. 8 years of your money sitting there, doing nothing. Or worse, slowly bleeding out. That's not a correction. That's a decade stolen from your financial life. Section 5. The Mirror. Today, 6 to 8. Mark Twain once said, "History doesn't repeat itself, but it does rhyme." And right now, the rhyme is so loud it's almost deafening. In 1972, the Nifty 50 made up 45% of the total US stock market. In 2025, just 7 companies. Microsoft, Apple, Google, Amazon, Meta, Tesla, and Nvidia make up roughly 36% of the entire S&P 500. 7 companies. 7 companies carrying the weight of the entire market. Are these great companies? Absolutely. No one is disputing that. But so was Xerox, so was Polaroid, so was Avon Products in 1972. A great company does not mean a great investment at any price. Now let's look at the valuations. Google and Meta, 28 times earnings. Amazon, 35 times earnings. Apple, 37 times earnings. Microsoft, 38 times earnings. Nvidia, 50 times earnings. Tesla, 247 times earnings. 247. The Nifty 50 averaged 42 times earnings in 1972. We're already past that. And just like in 1972, investors are telling themselves the exact same story. These companies are untouchable. They'll grow forever. This time it's different. We've heard that before. Now, I want to be clear about something. This is not a video telling you the market crashes tomorrow. Nobody knows when. Not me, not Warren Buffett, not anyone. What we do know, what history has proven over and over again, is that valuation eventually matters. Concentration eventually corrects. So what do smart investors actually do right now? First, understand what you actually own. If you're in an S&P 500 index fund, you're not as diversified as you think. You have a 36% bet on 7 tech companies. Know that going in. Second, think about valuation, not just quality. A great company at a terrible price is still a terrible investment. Coca-Cola was a great company in 1972. Didn't stop it from falling 60%. Third, have a plan before the panic. The people who got destroyed in 1973 weren't stupid. They just had no plan for when things went wrong. Have a plan, write it down, and stick to it when you're scared. Warren Buffett said it best. What we learn from history is that people don't learn from history. So here we are again, staring at a top-heavy market, worshipping the same stocks investors worshipped in 1972, whispering the 4 most expensive words in the English language. I'm not saying that this ends the same way. Maybe it doesn't. But the least you can do is look at the history. The least you can do is know what you own. The least you can do is not be surprised. Because the people who got hurt in 1973 were not unlucky. They just stopped asking questions. Don't stop asking questions.